The Dividend Snowball investment strategy focuses on harnessing the power of dividend payments to steadily grow wealth over time. But what pivotal role did dividends play during the lost decade of the early 2000s, and how did they reshape investor strategies amidst market turmoil today? We will get into that a little later after we discuss the dividend snowball benefits. Similar to the concept of a snowball gaining momentum as it rolls downhill, this strategy involves reinvesting dividends back into the same stock or other dividend-paying stocks, thereby compounding returns and gradually increasing the overall dividend income. At its core, the dividend snowball strategy relies on the power of compounding. When investors receive dividends from their investments, they have the option to reinvest those dividends to purchase more shares of the same stock. By doing so, they effectively increase their ownership in the company, and consequently, the amount of dividends they receive in the future. Over time, this process can lead to exponential growth in both the value of the investment and the income generated from dividends. Before we discuss the amazing advantages of this strategy, let's uncover the lost decade of the early 2000s and the reason dividend-paying stocks have long been a cornerstone of investment portfolios. Dividend-paying stocks offer not only regular income streams, but also insights into market trends and economic conditions. Delving into the annals of financial history, one finds a rich tapestry of dividends' impact on total returns, market performance, and investor sentiments. Taking a panoramic view of stock performance from 1930 to 2022 provides a nuanced understanding of dividends' significance. Over this period, dividend income's contribution to the total return of the S&P 500 index averaged a substantial 41%. This figure underscores the crucial role dividends have played in bolstering investor returns, particularly during tumultuous market periods. Seeing the S&P 500 index's performance decade by decade reveals the dynamic nature of dividends' contribution to total returns. During the 1940s, 1960s, and 1970s, decades marked by subdued total returns, dividends emerged as a significant driver of investor gains. Conversely, in the 1950s, 1980s, and 1990s, when average annual total returns soared into double digits, dividends played a comparatively smaller role. The 1990s witnessed a notable shift in investor sentiment towards dividends. Amid the dot-com boom, companies diverted their capital away from dividend payments, believing that reinvesting in business expansion promised greater returns. Consequently, dividends were sidelined as investors chased rapid capital appreciation. However, the dot-com bubble's eventual burst served as a stark reminder of the importance of fundamental indicators, prompting a renewed interest in dividend-paying stocks. The early 2000s, often termed the lost decade, marked a period of stock market turmoil, characterized by negative returns for the S&P 500 index. The aftermath of the dot-com bubble prompted investors to reevaluate their strategies, gravitating towards stocks with solid fundamentals, including attractive PE ratios and dividend yields. This shift underscores dividends' resilience as a reliable source of income, even during periods of market volatility. Analyzing the dividend yield for the S&P 500 index from 1960 to 2022 reveals intriguing patterns. According to Yale, the median dividend yield stood at 290% over this period, with peaks observed in the 1980s and in the 2000s. Today, in an era characterized by market uncertainties and volatility, investors are increasingly turning to dividend-paying stocks as a means to mitigate risk and secure steady returns. Now we know why dividend-paying stocks are so popular these days, but what about the amazing advantages? One of the key advantages of the dividend snowball strategy is its ability to generate passive income. Unlike capital gains, which are realized only when an investment is sold, dividends provide a regular stream of income that can be reinvested or used to cover expenses. This can be particularly appealing to investors seeking a reliable source of income, such as retirees or those looking to supplement their salary with additional cash flow. Furthermore, the dividend snowball strategy offers a level of stability and resilience during market downturns. Since dividends are typically paid out of a company's profits, dividend-paying stocks tend to be more stable and less volatile than non-dividend-paying stocks. Additionally, companies that consistently pay dividends are often well-established and financially sound, which can provide a degree of downside protection during economic downturns. Implementing the dividend snowball strategy requires careful selection of dividend-paying stocks. Investors typically look for companies with a history of stable or growing dividends, strong financial fundamentals, and a sustainable business model. Diversification across different sectors and industries can also help mitigate risk and enhance the overall stability of the portfolio. Once the initial investments are made, The dividend snowball strategy relies on disciplined reinvestment of dividends over the long term. As dividends are received, they are automatically reinvested to purchase additional shares of the same stock or other dividend-paying stocks. Over time, this process accelerates the growth of the investment portfolio and the income generated from dividends. As the investment portfolio grows, so too does the income generated from dividends. This creates a virtuous cycle where increasing dividends lead to larger reinvestments, which in turn generate even more dividends. Over many years, the compounding effect can result in significant wealth accumulation and a reliable source of passive income. Before we get into an example, click the like button if this video has been eye-opening. Let's consider an initial investment of $10,000 in Company A, which pays a quarterly dividend of $2.50 per share. After the first year, you own 100 shares, as your $10,000 investment buys you 100 shares. Therefore, you receive $1,000 in dividends at the end of the year from 100 shares. Instead of pocketing the dividends, you reinvest them to purchase more shares of Company A. Assuming the price of one share stays $100, you buy 10 additional shares at the current market price. Now in year 2, you own 110 shares of Company A. Since the company continues to pay a $2.50 dividend per share, your total dividend income for the year amounts to $100. Again, you choose to reinvest this entire amount back into purchasing more shares of Company A. This reinvestment buys you another 11 shares. This process repeats itself over subsequent years, with your share ownership and dividend income steadily increasing. By the 10th year, your initial investment of $10,000 has grown significantly. Due to the compounding effect of reinvesting dividends, your annual dividend income has become substantial. This demonstrates how the dividend snowball strategy can gradually build wealth over time, leveraging the power of compounding to accelerate your financial growth and increase your passive income. Let's get into examples of real-life billionaires and entrepreneurs who used this strategy and accumulated riches. Warren Buffett, a well-known investor and businessman, exemplifies the power of long-term investing and compounding returns. Buffett's investment philosophy revolves around seeking undervalued companies with strong fundamentals and holding on to them for the long haul. While Buffett's approach may not align perfectly with the traditional dividend snowball strategy, he has consistently reinvested dividends from his investments to compound his returns over time. Berkshire Hathaway's investment portfolio includes many dividend-paying stocks, and Buffett has always emphasized the importance of reinvesting profits to maximize growth. By continually reinvesting dividends and letting his investments compound, Buffett has been able to achieve remarkable wealth accumulation over several decades. His disciplined approach to investing, coupled with his patience and long-term perspective, has made him one of the most successful investors in history. While Buffett's specific investment decisions may vary, the overarching principle of compounding returns through reinvestment remains a fundamental aspect of his strategy. This demonstrates how the principles of the dividend snowball strategy, such as reinvesting dividends to generate exponential growth, have been instrumental in Buffett's investment success. Bill Gates, the co-founder of Microsoft and a tech visionary, has not only made his mark in the world of technology, but also demonstrated astute investment acumen. While Gates is renowned for his entrepreneurial endeavors, he has also diversified his wealth through strategic investments. Although his investment approach may not strictly adhere to the traditional dividend snowball strategy, Gates has leveraged the principles of compounding and reinvestment to grow his wealth over time. Through his investment company, Cascade Investment LLC, Gates has made strategic investments in various sectors, including technology, healthcare, and energy. While these investments may not always involve dividend-paying stocks, Gates understands the importance of reinvesting profits to fuel growth and maximize returns. One notable aspect of Gates's investment strategy is his long-term perspective. Rather than seeking short-term gains, Gates focuses on identifying high-quality companies with strong growth potential and holding on to them for the long haul. This patient approach allows him to capitalize on the power of compounding and generate significant wealth over time. While Gates's investment decisions may vary based on market conditions and emerging opportunities, his commitment to long-term value creation and disciplined reinvestment of profits underscores the importance of compounding and building wealth. Microsoft paid a dividend to its investors in 2003 and quarterly dividends starting in 2013. This demonstrates how the principles of the dividend snowball strategy, such as reinvesting dividends and maintaining a long-term perspective, have been integral to Gates's investment success, alongside his achievements as a technology pioneer. But wait, how can we implement this strategy and how can we leverage its benefits? Listen carefully, as this could pave the way for you to achieve billionaire status in this lifetime. Here's how you can maximize capitalizing on this strategy. 1. Start early and be patient. The snowball strategy works best when given time to accumulate. Start investing as early as possible to take full advantage of compounding. The longer your investments have to grow, the more significant the impact of compounding will be. 2. Select dividend-paying stocks. Look for companies that have a solid history of paying consistent and growing dividends. Focus on companies with strong fundamentals, stable cash flows, and a track record of increasing dividends over time. Diversify your investments across different sectors to reduce risk. Dividend kings are companies that have consistently paid dividends and grown their dividend payouts for over 50 years. Coca-Cola, Johnson & Johnson, Procter & Gamble, and Colgate-Palmolive are dividend kings that have consistently given out dividends for over 60 years. Let me know in the comments if you want a dedicated video about dividend kings. 3. Reinvest dividends. Instead of cashing out dividends, reinvest them back into the same stock or other dividend-paying stocks. Reinvesting dividends allows you to buy more shares, which in turn increases your future dividend income. Over time, the compounding effect can significantly boost your investment returns. 4. Automate reinvestment. Set up automatic dividend reinvestment plans, DRIPs, with your brokerage account. DRIPs automatically use dividends to purchase additional shares of the same stock, making it easy to reinvest dividends without any manual intervention. This ensures that you consistently reinvest dividends and take full advantage of compounding. 5. Stay disciplined. Stick to your investment plan and resist the temptation to deviate from it, especially during market fluctuations. Avoid making emotional decisions based on short-term market movements. Stay focused on the long-term growth potential of your investments and continue reinvesting dividends regularly. 6. Monitor and adjust. Regularly review your investment portfolio to ensure it remains aligned with your financial goals and risk tolerance. Periodically reassess your investment strategy and make any necessary adjustments based on changes in market conditions or your circumstances. 7. Patience is key. The snowball investment strategy requires patience and discipline. It may take time to see significant results, but over the long term, the power of compounding can lead to substantial wealth accumulation. Stay committed to your investment plan and trust in the process. By following these steps and consistently reinvesting dividends over the long term, you can harness the power of the snowball investment strategy to grow your wealth and achieve your financial goals.